In this video, we're going to walk through a problem related to compensated absences. But before we do that, we're going to take a look at a little bit of background material. There are a variety of employee-related liabilities. Compensated absences are just one, and that's the one we're taking a look at in this particular problem. We've got paid absences for vacation, illness, and holidays. And basically, we need to accrue a liability if all of the following conditions are met. The first condition is that the employer's obligation is attributed to the employee's services already rendered. In other words, it's something that the employee has already performed for us. And again, this is why we record expenses. We try to match the cost with the revenues the employees have generated. So if the employee has already rendered a service, then we may need to accrue a liability for vacation time, illness, or holidays. Next, the obligation relates to rights that vest or accumulate. We'll talk about what vest or accumulate means in a few moments. The third condition is that the payment of the compensation is probable, and we'll talk about what that means. And then also that the amount can be reasonably estimated. Let's move on and take a look at some terminology. First, what are vested rights? If the employer has an obligation to make payment to the employee even after terminating his or her employment, then the employee has a vested right in a particular benefit. Accumulated rights are those that employees can carry forward to future periods. Next, we want to sort of hit at the notion of what we're going to talk about later, which is loss contingencies. With loss contingencies, the FASB uses three areas of probability: probable, reasonably possible, and remote. The term probable is pretty easy to define. Probable is greater than 50%. If it's more than 50%, well then it's probably going to happen compared to something that happens less than 50%. That's less than probable. The other two terms, reasonably possible and remote, there's a lot of variation within the profession as to what those mean. Typically, accountants will rely on legal representation letters with respect to contingencies, which again we'll discuss later on. And the attorney's evaluation is something being reasonably possible or remote. And again, a lot of variation. So again, right now we're looking at compensated absences, and two of those requirements is that that compensation is both probable and we can have a reasonable estimate. And I just want you to see the connection between this and loss contingencies. As we just discussed, loss contingencies can be broken down into three different types: probable, reasonably possible, and remote. The accounting treatment, we're going to either accrue in a dollar amount, disclose it in the footnote, or ignore it, depending on whether something's probable, reasonably possible, or remote. We're going to take a look at those. If it's remote, we just ignore it. We don't put a number on the balance sheet, nor do we disclose any information in footnotes. If, however, it is reasonably possible that we're going to have a liability in the future, we're going to include a footnote in the financial statements. Now, if it's probable, we've got one or two things we can do with it. If it's probable and we can't come up with a reasonable estimate, in other words, we can't put a number on it, well, how could we put it on the balance sheet? We can't. So we'll just disclose it in the footnote. On the other hand, if it's probable and we can come up with a reasonable estimate of the probable amount we might pay in the future, then we can put a number on the balance sheet. Of course, we'll discuss it in the footnotes as well. Let's get back to our problem on compensated absences. We're told that the Matt Broderick Company began operations January 2, 2020, and the following information is provided. We have 9 employees. They have worked 8 hours per day. We have 10 sick days per year, or vacation days per year, and 6 sick days per year. Vacation days may be taken after January 15th of the year following which they are earned. So in other words, there's accumulated rights to the sick leave, to the vacation time. Sick leaves do not accumulate. So unused sick leaves, you either use the sick leave, use it, or lose it. And we've got the following information. Wage rates for each year. 2020 was $10. 2021, the wage rate went up to $11. In 2020, no vacation time was used because it can't be used until the year following it being earned. 2021, there were 9 days. 6 days, there were 4 days in 2020 and 5 days in 2021. And we're going to need to prepare journal entries for our vacation and sick leave for 2020 and 2021. So let's go ahead and begin taking a look at that. To calculate our accrued vacation time for 2020, we begin with the number of employees, which was 9, the wage rate, which is 10. Our employees, again, work 8 hours per day, and they earn 10 days of vacation time during the year. So the total accrued vacation time at the end of 2020 will be $7,200. And again, that's 9 employees times $10 an hour times 8 hours a day times 10 days. So our journal entry will be a debit to salaries and wage expense and a credit to salaries and wages payable. If we look at our T account, we just started business in 2020, so the beginning balance was 0. We've increased the liability by $7,200, and our ending balance is $7,200. Now, some of you might have observed that since our employees can't take their vacation time until next year, perhaps we should accrue at the $11 wage rate that the employees expect to earn in 2021. Firms under GAAP have the choice between accruing at the current wage rate or the future wage rate. We need to follow a consistent pattern on how we do it, however. All right, our vacation time used in 2020. Again, we can't take vacation until January 15th of the following year, so we have nothing for vacation time used, and there's no entry for 2020. Sick leave, we use it as we accrue it, and we were told that employees took 4 days of sick leave in 2020. So we take the $10 an hour wage rate, 8 hours a day, 4 days of sick leave. We've got sick leave of $2,880. We debit salary and wage expense, and we credit cash because we've gone ahead and paid the employees for those days they've missed. All right, for 2021, we are told that in terms of accrued vacation, again, we've got 9 employees. We're now accruing at an hourly rate of $11 an hour, the same 8-hour days, the same 10 days of vacation time. So our accrual will be $7,920. We will debit salaries and wage expense for $7,920, and we will credit accrued salaries and wages, or salaries and wages payable. If we want to take a look at our T account, recall we had $7,200 accrual from last year that carried forward. We've just accrued an additional $7,920. And now we can go ahead and take a look at what was taken in terms of vacation expense during the year. Now keep in mind, the entry we've made here for our accrual probably is going to be at year end, and the entry we make for vacation that we use would probably be happening during the period of time that we're talking about, during 2021. So we're told that employees have used 9 days of vacation time in 2021. So we're going to take the 9 employees, $11 an hour times 8 times 9. We have $7,128 in vacation pay that we're going to pay our employees. We will debit salaries and wages payable because, again, we set up an accrual at the end of last year to handle this estimated future liability. So we're now taking that liability off our books, and we, of course, will credit cash. So if we want to look at our T account, that debit to wages payable will reduce our liability on our balance sheet. Finally, that will give us a year-end balance for 12/31/20, and this should barely be 2021, will be $7,992. Vacation pay, we're told that sick time, we're told that the employees took 5 days of sick leave in 2021. So our calculation, again, 9 employees at 11 times 8 times 5, that gives us sick leave of $3,960. And again, that was the sick days used by each employee. It's probably really an average. But in any event, our journal entry then, we're going to debit salaries and wage expense for $3,960, and we will credit cash for $3,960. And again, notice the difference. When we paid for vacation time, we debited salaries and wages payable rather than salaries and wages expense, because the employees worked for us in 2020 to earn vacation time that they could take in 2021. The matching principle says we needed to record that salary and wage expense back in 2021, and that's what we did with our accrual at the end of 2020. And finally, one last question. Again, under what conditions must an employer accrue a liability for the cost of compensated absences? And it required 4 conditions to be met. That first was that the obligation arises from services that have already been rendered by the employee, the rights vest or accumulate, the payment of the compensation is probable, and the amount can be reasonably estimated. We have a slight modification to this general rule. If sick pay rights vest, a company must accrue them. If sick pay rights accumulate but do not vest, then the company may choose whether to accrue them or not. And the question might become then, why the difference? Well, the difference is because it must pay vested rights, but it will only pay accumulated rights to sick leave if the employee is sick in the future.